The beginning of 2020 has been a tumultuous period for China. January and February saw authorities respond to COVID-19's threat with a complete lockdown of Wuhan, as well as stringent restrictions on travel and trade elsewhere across the nation. The economic consequences of these restrictions is severe. Year-end GDP growth falling from plus 6% at December to minus 6.8% at March. This is an unparalleled outcome through history. Thankfully, having seemingly brought COVID-19 under control within its borders, and with precautions against an importation of a second wave in place, China's economy is poised to recover. Anecdotes in the March PMIs indicate that industry in most regions of China was close to full capacity at month's end. Credit data for the month was also constructive. There is therefore good reason to believe that the nascent rebound in fixed asset investment that was reported in March will also strengthen through to mid-2020. Coupled with the restarting of industry, continued gains for investment should also secure a robust, rising trend for employment and consumer spending. While China is getting back on its feet, however, the rest of the world is coming under extreme economic stress. Most notable is the shockwave being felt in the US. In just 4 weeks, 22 million US citizens have lost their jobs and applied for unemployment benefits. This data implies that the US unemployment rate will rise from 4.4% in March to around 15% in April. Job losses are likely to continue for a time. Hence, the peak unemployment rate in the US is likely to be above 20%. We assume the outbreak will come under control in the US in the second half of 2020. But in opening up their societies, the US states are likely to be much more cautious than President Trump intends. As a result, US unemployment is likely to remain elevated for a long period, holding above the GFC peak of 10% into 2021 and ending that year near 6%, materially higher than the recent low of 3.5%. The biggest immediate hit to GDP growth from high unemployment will come via consumption. While households are currently not consuming because stores are shut, spending's absence will increasingly be due to lost income and wealth, as well as a fear over how long this shock could persist. Also significant for the outlook is the deterioration evident in business investment, as it is investment which dictates income and its distribution over the long term. Whereas Chinese authorities are actively seeking to promote a robust and sustained uptrend in investment from February's low, in the US there is no such support. US businesses will therefore hold back on investment until they are confident in the recovery. On the back of the differentials in consumption and investment, whereas year average growth in China will bounce quickly from little more than 0 in 2020 to around 10% in 2021, the US is likely to see a gain of just 1% in 2021 after a loss of 6% in 2020. While there are clear downside risks to these views, the skew of risk is against the US more than China, given China's policy coordination, its state of economic development, and its determination to drive towards prosperity as a nation. We'll see you next week.